Our next guest says think of the tech sector as similar to a long-term bond. Tech will fluctuate with the market's evolving thoughts about the future path of interest rates. Joining us is Caron, Senior Portfolio Manager with Washington Crossing Advisors. Let me begin by asking you a question similar to the one I just asked Mike Santoli, and that is, what is the relationship between yields and tech shares, or yields and the NASDAQ? We've seen the NASDAQ go up as yields went up. Now we've seen the NASDAQ go up as yields come down.
Yeah, well, what we're saying there is that when you look at technology, it's trading at a much bigger premium, bigger multiple than the average company at this point. And what that means is that the value of those technologies, that technology sector, the share prices, if you will, it's tied up in earnings that are going to happen years and years from now. So those earnings are going to be hurt if you raise the interest rate and you discount those back. They're going to behave sensitive to higher interest rates. But, and there's a big but here, it's not the only thing that affects technology. For example, they're also going to be big beneficiaries of receding fears about recession. And that's what happened this year. That was the dominant story this year. And if you look at tech earnings, the expected earnings have ratcheted up about 14% this year, and you can't say that for the rest of the S&P. So ultimately, yes, they're still sensitive to interest rates. That's still a headwind if interest rates climb from here, but they're going to benefit from things like a stronger economy, higher earnings like they did this year, and that was the overriding factor for tech this year. So
in short, other intervening factors have overwhelmed the normal state of affairs, which would be that rising rates are not good news for tech stocks because it reduces the value of future earnings.
Yeah, there's just a lot of moving parts here. It's not just a one-way thing about interest rates. There are several factors that come into play, and growth is a big one as it relates to technology, and growth has clearly gotten better this year than what was expected at the start of the year.
We've spent much of the last decade poo-pooing the value of a 60-40 portfolio blend. Is it back in vogue now?
Oh, absolutely. The whole idea with that was that if you ended up with a situation where stocks fell and bonds fell as they did last year, then diversification wasn't your friend and you didn't have much of a yield to start with. But that's different now. We do have a yield that is very favorable. It's above the rate of inflation, so you have a real yield. Bond investors are coming into it today with a very different setup. And the historic tendency, although not all times, but the historic tendency for bonds to be the offset to a worsening economy, that could still very much be on the table. So the potential for diversification and a better starting yield means that absolutely the 60-40 traditional stock bond mix is very much alive and well today.
Oh, now that's the most contrarian thing I think of. You saw what David Einhorn just said, Kevin. He said basically he's betting the opposite.
Yeah, well, I disagree. I would take the other side of that. Things don't stay static in markets. The starting yields today are much better than they were in the past, and ultimately, if you're starting with a higher yield, all else being equal, then the expected returns on bonds today would be better than where they were a couple of years ago. So I would take the other side of that trade.